For some, the idea of investing can seem intimidating. You might think that investing is something reserved for the wealthy or those with lots of extra cash. But that's simply not true. With as little as $100, you can begin your journey toward financial growth. Whether you're looking to build wealth, save for a major life goal, or just become more financially literate, investing is one of the best ways to make your money work for you. So let's break this down and explore how you can get started. First, I want to emphasize that investing isn't about getting rich overnight. It's a long-term commitment that requires patience, discipline, and a willingness to learn. With a small mean like $100, your goal should be to establish a solid foundation for your financial future rather than expecting a windfall right away. The key is to take the first step and build momentum. Now, before we dive into the specifics of where to invest your $100, it's important to understand why investing is essential. Simply putting your money in a savings account or keeping it under your mattress doesn't generate wealth. Inflation erodes the purchasing power of your savings over time. For example, if inflation is at 2% per year, your $100 today will be worth only $98 in a year, assuming you don't do anything with it. Investing allows you to grow your wealth and beat inflation. When you invest, you're putting your money into assets that have the potential to grow in value over time. These assets can be stocks, bonds, real estate, or even commodities like gold. And while there are risks involved because markets can fluctuate, there's also a reward for taking a smart and calculated approach. So, where do you start? Let's explore some ways to invest with just the first. One of the most popular and accessible ways to invest is through stocks. Buying shares of a company means you own a small piece of that company. As the company grows, your shares may increase in value, allowing you to profit. Now you might think, how can I buy stocks with just $100? Doesn't the stock market require a lot of money? The answer is no, not necessarily. While some stocks can be expensive, there are plenty of affordable options available. Plus, fractional shares make it even easier for people with smaller amounts to get started. Fractional shares allow you to buy a portion of a stock rather than having to purchase a whole share. For example, if a stock costs $200 per share and you only have $100 to invest, you can still buy half a share. Apps like Robinhood, Webull, and M1 Finance allow you to buy fractional shares without paying commissions or fees, which makes it easy to get started. You can invest in well-known companies like Apple, Amazon, or Tesla, or choose from a variety of stocks in different industries. This strategy allows you to diversify even with a small amount of money. Next, you might consider investing in exchange-traded funds, ETFs. ETFs are baskets of stocks, bonds, or other assets that you can buy and sell like individual stocks. They allow you to diversify your investments without having to pick individual stocks. For example, an ETF might hold shares of major tech companies, or it might track the overall performance of the entire stock market. ETFs are particularly useful for beginners because they spread out your investment risk. Instead of buying just one stock, you're buying a collection of assets. This means that if one stock doesn't perform well, the others in the ETF may help offset the loss. There are ETFs for almost every type of investment strategy. Some are focused on growth, others on income generation, and some are designed to track specific sectors like healthcare, technology, or real estate. And just like with stocks, many platforms allow you to buy fractional shares of ETFs, so you don't need a large amount of money to get started. Another excellent way to begin investing with $100 is through robo-advisors. Robo-advisors are online platforms that provide automated investment advice based on your financial goals and risk tolerance. These services are incredibly popular because they make investing simple, even for beginners. You don't need to worry about picking individual stocks or managing your portfolio. The robo-advisor does that for you. One popular robo-advisor is Betterment, which offers low fees and a variety of investment portfolios to suit different goals. For instance, if you're saving for retirement, you can select a retirement-focused portfolio. If you're aiming for long-term growth, you can choose a portfolio designed for that. The robo-advisor will handle everything from allocating your money across different assets to rebalancing your portfolio over time. Robo-advisors are a fantastic choice if you're looking for a set-it-and-forget-it approach. With just $100, you can start investing, and the platform will gradually help grow your wealth over time. The fees are usually low, typically around 0.25% to 0.5% of your assets annually, which is much cheaper than traditional financial advisors. If you're interested in more hands-on control of your investments, you could also explore real estate investment trusts, REITs. A REIT is a company that owns and manages real estate properties such as shopping malls, apartment complexes, and office buildings. When you invest in a REIT, you're essentially investing in a portfolio of real estate assets. REITs are appealing because they allow you to invest in real estate without having to buy property yourself, which is expensive and time-consuming. With just $100, you can invest in a REIT and start earning dividends from the rental income generated by the properties in the trust. Many REITs are publicly traded, so they're easy to buy and sell, just like stocks. Another option to consider is peer-to-peer lending. This is an innovative way to invest where you lend money to individuals or businesses through online platforms. In return, you earn interest on the loan. Some popular peer-to-peer lending platforms include Lending Club and Prosper. These platforms connect you with borrowers who are looking for loans, and you get to choose which loans to fund. The risk with peer-to-peer lending is higher compared to traditional investments like stocks or ETFs, as borrowers may default on their loans. However, if you diversify your loans across different borrowers, you can reduce your risk. If you're interested in something a bit different, you might also look into cryptocurrencies. Cryptocurrencies like Bitcoin and Ethereum have gained popularity in recent years, and many people view them as a store of value or a potential hedge against inflation. While cryptocurrencies are volatile and risky, they're accessible for small investors. With platforms like Coinbase and Binance, you can buy small amounts of cryptocurrencies for as little as $10 or $20. You can use your $100 to purchase a fraction of a Bitcoin or other altcoins. But it's important to remember that the crypto market can be unpredictable, so it's best to approach this type of investment with caution and only invest money you're willing to lose. Lastly, you may want to consider investing in yourself. While this doesn't involve a traditional investment in stocks or bonds, spending your $100 on learning opportunities, such as online courses, books, or seminars, can pay off in the long run. The more skills and knowledge you acquire, the more valuable you become in the job market or as an entrepreneur. Whether it's learning about finance, improving your technical skills, or gaining expertise in a new field, investing in yourself can increase your earning potential and future opportunities. Now, before you dive into any of these investment options, it's crucial to do your research. Every investment carries some level of risk, and the more you understand about the asset you're investing in, the better equipped you'll be to make informed decisions. Don't rush into investments without understanding what they are, how they work, and what kind of returns you can reasonably expect. Another key point to remember is that investing is a long-term game. With $100, you might not see huge returns right away. But by consistently investing and sticking to a strategy, your wealth can grow exponentially over time. Compound interest is a powerful force. As your money earns interest or dividends, it will begin to generate its own returns, creating a snowball effect. Also, consider diversifying your investments. Putting all your $100 into a single stock or asset can be risky. Instead, consider spreading your investment across different types of assets, like stocks, ETFs, and bonds. Diversification helps minimize risk and gives you a better chance of seeing positive returns overall. Finally, I want to highlight that investing is about building habits. Start small, be consistent, and don't be discouraged if you don't see immediate results. Over time, with discipline and patience, you can turn that $100 into a much larger sum. To conclude, investing with just $100 is absolutely possible, and it can be the first step towards securing your financial future. Whether you're buying stocks, ETFs, REITs, or exploring newer options like crypto, the key is to take action. Learn as you go, diversify your investments, and remember that the goal isn't to get rich quickly, but to steadily grow your wealth over. Starting with low-cost, accessible investments is one of the most effective ways to begin your investment journey with as little as a. Many beginners are discouraged from investing because they believe it requires large sums of money, but the reality is that the modern investment landscape has made it easier than ever to get started, even with small amounts. One of the best ways to invest with a small budget is by purchasing fractional shares. Fractional shares allow you to buy a portion of a stock rather than having to purchase a full share. For instance, if a single share of a company like Amazon costs $3,000, you may not have that much to invest. However, with fractional shares, you can invest $100 and own a fraction of that Amazon stock. This means you can still benefit from the growth of large, established companies without needing to invest thousands of dollars. ETFs, exchange-traded funds, are another great option for small investors. ETFs are essentially baskets of stocks or other assets, and they allow you to diversify your portfolio with a single investment. For example, an ETF could include a mix of tech stocks, healthcare companies, or even international stocks, giving you exposure to different industries and reducing the risk of investing in just one company. Many brokers now offer the ability to buy fractional shares of ETFs, meaning you don't need a large sum of money to build a diversified portfolio. With platforms like Robinhood, Webull, or M1 Finance, you can easily access fractional shares and ETFs with no minimum investment, and in many cases without paying any commissions or trading fees. These low-cost options are perfect for beginners who want to start investing with $100 or less, allowing them to build their portfolio while keeping fees to a minimum. Consider automated investing with robo-advisors as an excellent way to get started with investing when you have as little as 100. Robo-advisors are online platforms that provide automated financial advice and manage your investments for you based on your goals, risk tolerance, and time horizon. They make investing simple and accessible, especially for beginners who might feel overwhelmed by the complexities of choosing individual stocks or managing a portfolio. Robo-advisors work by using algorithms to create and manage a diversified portfolio of low-cost investments, typically including index funds or exchange-traded funds, ETFs. When you sign up for a robo-advisor, you'll fill out a questionnaire about your financial goals, such as saving for retirement or building long-term wealth, and your tolerance for risk, conservative, moderate, or aggressive. Based on your responses, the robo-advisor automatically suggests a portfolio that aligns with your needs and then takes care of all the maintenance, like rebalancing the portfolio and reinvesting dividends. What makes robo-advisors particularly appealing for small investors is the low minimum investment requirements, which can often be as low as this means that with just a small amount of money, you can begin investing in a diversified portfolio that would typically require much more capital if managed manually. Another advantage is the relatively low fees. Most robo-advisors charge an annual management fee that ranges from 0.25%, which is far less than the fees typically charged by traditional financial advisors. Platforms like Betterment and Wealthfront are popular examples of robo-advisors that offer these services. They provide a user-friendly interface so you can easily track your progress and make adjustments to your strategy if needed. Robo-advisors make it easy for beginners to enter the world of investing, take a hands-off approach, and stay focused on long-term growth. Exploring alternative investments can be an exciting way to diversify your portfolio, especially when starting with a modest amount like a. While stocks and bonds are the traditional investment vehicles, alternative investments can offer unique opportunities for growth and income, often with a different set of risks and rewards. For investors who may be looking to branch out beyond the stock market, options like peer-to-peer lending or real estate investment trusts, REITs provide interesting alternatives. Peer-to-peer lending is a relatively new concept that connects individual investors with borrowers who need personal loans. Through online platforms like Lending Club or Prosper, you can lend money to individuals or small businesses in exchange for interest payments. This can be an appealing option because it allows you to earn higher returns compared to traditional savings accounts or bonds. With $100, you can diversify your investments by lending to several borrowers, thus spreading out the risk. However, there are risks involved, such as the possibility of loan defaults. So it's important to choose platforms with strong borrower vetting processes and a variety of investment options. Another alternative investment worth exploring is real estate investment trusts, REITs. REITs are companies that own and manage income-producing real estate properties like shopping malls, office buildings, or apartment complexes. By investing in a REIT, you get exposure to real estate markets without having to buy physical property, which typically requires much more capital. Many publicly traded REITs have low minimum investment requirements, making them accessible even to small investors. With $100, you could invest in a REIT and begin earning dividends from the rental income generated by the properties within the trust. Alternative investments can enhance your portfolio's potential by adding diversification and potentially higher returns. While they come with risks, they also offer opportunities for investors to gain exposure to markets and assets beyond traditional stocks and bonds.